Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be on the show again.
Hilliard, could they have picked up the thump on the floor when jaws dropped in Edmonton when the price of international oil fell to minus $38 yesterday?
It was pretty amazing to watch that. You know, of course, as you know, I've been doing this for over 40 years and never seen it. Even in the days of the National Energy Program and all of the bankruptcies in 1980 and all the surges in oil and then the collapses down below $10 a barrel. There's never been anything like this. But this is also not just the price of oil. This is a function of the commodity futures trading contracts and something called an exchange traded fund that was trading them. And this is brand new in this time. So in the years 40 years ago, it was really just oil and oil companies trading oil, and there were the fancy derivative trading. Really, it was only just a tiny fraction of what it is today. And so that's how you get these strange occurrences.
Now, today the price of oil, you know, according to the Bloomberg screen, has gone up about $40 or so. So it's no longer negative. But what did it mean yesterday? If you bought oil futures then, does that mean you would have made a huge profit?
So it gets a bit technical. So I did actually at one time have the job of being the commodities trading supervisor at the branch of one of the Edmonton brokerage firms. There was only two Edmonton brokerage firms that did commodities trading, because commodities trading is different from everything else. And contracts trade either on Chicago or New York now. And each contract in crude oil is 1,000 barrels. And so what happens is, because it's such a volatile trading instrument, the crude oil contract is very, very popular, but also very, very scary in a way. So what they do is, for the May contract, it sounds like the May contract should go to May, but it actually ends today. So it's 4 days prior to the 25th day of the month preceding the date for delivery. So if you hold that contract today, you're the last. It's like a game of musical chairs. The music stops, everybody sits down, and then somebody doesn't have a chair. Well, the analogy is that if you own those contracts today and today expires, then you have to find a place to put that oil. So if you own a million contracts, that's a billion barrels of oil. Well, that's a bad example, but 100 contracts, you have to find space for 100,000 barrels of oil, and there's no storage left that's not full. So that's why they were so desperate to unload it yesterday. And now today it's rallied because we're getting towards the end now and it's just about finished. It'll on Tuesday it'll end around noon or 1 o'clock. And but then the next contract that's going to expire is June, and that one will expire towards the 3rd or 4th week of May. And now already that contract has gone down from $20 where it was on Monday to $10 where it is today on Tuesday as we talk. And that's because the problem is not over yet. There's still going to be a problem at the end of May finding places to store oil for June. And the problem really won't be resolved until some of that oil comes out of storage. And that means when people get in their cars and start driving again.
Well, so what happens to this oil if they say the storage is full? Is it just flowing out onto the ground? Can they stuff it back into empty wells? How does it work?
Yeah, I don't know. There'll be some financial repercussions, but one of the things that's happening is kind of interesting is you might be able to put it in trucks or on maybe you could find a pipeline somewhere that isn't completely full and send it out to the ocean. So this is what we're talking about in this particular contract is Cushing, Oklahoma. And then there's pipelines that go to the coast, the Gulf of Mexico, and it can go on tankers. So I would imagine there's tankers. There's something like 200 million barrels already of oil floating around the world on tankers. And these tankers have to stay out in the ocean because they have no place to unload the oil because nobody wants the oil. So there might still be tankers waiting to be loaded offshore, and maybe that's what people will have to do. They'll have to contract a tanker. There's a few stocks that trade on the stock market that represent ownership in some of these tankers, and they, as fast as oil was dropping yesterday, the share prices of ownership of companies that hold tankers was rising, and today on Tuesday it was up 5 or 10%. Each of them was up that much. So the daily rental for tankers to be used as storage is skyrocketing. They're not using these tankers to deliver the oil anywhere because there's no place to deliver it. Nobody wants oil, but they can use it as temporary storage. And maybe in the third quarter, the fourth quarter, we'll go back to normal where planes are flying again and cars are driving and trucks and everything, and then they'll find a place for this oil. To give you an idea, about before this happened, before this recession and COVID-19. The world used about 100 million barrels per day of oil. And after, as a result of everybody being locked down and most of the flights being canceled, I've seen estimates anywhere from 70 to 80 million barrels a day. So the drop is 20 to 30 million barrels. But the people that produce it have not really cut back on their production. So it's a massive catastrophe in the making in terms of the excess oil that's floating around. Now, there is one place in the world that could store a lot of oil, and that's the U.S. Strategic Petroleum Reserve, which I'm not sure. I think it's probably in Texas. And they apparently can hold up to 250 million barrels, or they have room for 250 million more barrels, perhaps. And so they could do that. That would be very helpful at this point. There's a lot of people that are desperate to find a place to put their oil.
Of course, once this stored up oil is starting to be used, does that mean we're going to enjoy low gasoline prices for a long time?
Certainly looks like for a while anyway. And, one of the things that is very high correlation is the price of gas and how much driving people do. So if the price of gasoline, which I think I saw like 58 cents in Edmonton a couple of days ago, if it stays that low, you'll see people getting out and using their cars a lot more. Maybe they'll drive instead of flying or something like that. I don't know exactly how it works, but there's a tremendous correlation to that. The biggest correlation of all is the price. Now there's a way you can track it apparently. I haven't done this, but Google Mobility and Apple Mobility, you can go on there. I don't know if you need a subscription or not, and they can tell you how much movement people are doing in their cars. And apparently the levels worldwide are extremely low, like India, China, Europe. The amount of driving that's going on right now is extremely low. So this is spooking the people in the oil market. But of course that could rebound very quickly. I think once people are allowed to get back and get going again, they definitely will start burning more oil. But some of the cities in Europe, I was just reading this morning, are starting to consider, like Madrid is one and Milan is another one. They're considering, because the streets are so empty right now, they're considering putting up barriers so that half the street would now be for pedestrians and bicycles, and only half the street would be available for automobiles. So when people do go back to using their cars again, they may find it's not quite as car-centric, the traffic circulation as it was before.
Of course, those are very concentrated cities, old cities where they have narrow streets. Maybe that's not a problem. But in North America, I mean, with suburbia, we are spread out all over the place. In a lot of places, life without a car is almost impossible.
Yeah, if you have to go to work, I mean, one of the things that I'm sure we'll talk about more in the future is now that we've learned how to work at home, maybe we don't need to go, like, everybody arrives at 8 o'clock in the morning in a big rush hour, and then everybody at 5 o'clock leaves the central core of the city and goes back home again. I mean, wouldn't it be great if that rush hour could be cut in half by just having more people working at home, or maybe only work at home every second day and go to the office every second day. And immediately the traffic jam is reduced, and that would make a big difference to automobile traffic. On the other hand, if the virus stays around, people may decide it's more important for them to have a car than to travel on public transit, and so you may see more cars on the road. If people are still, we don't know when they let us back out of our homes whether there's going to be a cure or a vaccine, or whether we're just going to be still worried all the time about contracting the virus. And I imagine if we're still worried about contracting the virus, then the public transit could suffer for a long time.
In Vancouver, the TransLink, the transit authority, is cutting its rapid transit SkyTrain service, closing down bus routes because of the lack of ridership and revenue right now. Perhaps some of those routes won't come back, so yeah, you'll need a car. Environmentalists right now are saying, well, look at this, we have clear skies because of the lack of cars, but this may force the use of more cars.
If we get testing up and running, you may be able to go onto public transit if you have a certificate that says you had a test this morning that says you were clear of the virus, and then everybody on the bus would have the certificate, and you wouldn't have to worry about it. But it's the other thing would be just to stay home and work from home. I'm amazed at how easy a transition, because I'm still working, and I've got everything. I've got my access to all my files that I had. I've got access to obviously to the email, the telephone, the data I need, and it seems like what's come back more now is more phone calls, partly because everybody's easy to get a hold of now, and but certainly in an age of phone calls and email and that Zoom meetings, WebEx meetings, maybe we'll find that not everybody, of course, can stay at home. For those people who can stay at home, it may become the thing to do, which has got long-term implications for not just traffic, but for office towers and things like that.
We'll have more with Hilliard MacBeth right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, what kind of impact do you think this is going to have on commercial real estate in the long run, with so many people working from home and companies finding out they're just as efficient or more efficient with people not having to commute every day and perhaps a little pressure when they hit the computer or phone?
Yeah, it could be very big. I mean, the number of the excess commercial office space in cities like Calgary, Edmonton, I don't know about Vancouver and Toronto, but certainly Calgary and Edmonton, it's enormous. There's in Calgary, there's several. There's one tower, I forget the name of it, but one tower has gone completely dark, and there's basically the equivalent of 3 or 4 towers of office space that's completely empty that you could find. And there's probably more because somebody who has a lot of space that doesn't need it all, there's not even any point in bothering to try and get out of it or to try and sublet it because there's no demand. So if demand picks up, there'll be some more space that comes free. And so there was a couple of big new buildings in Calgary, Brookfield, and TELUS that were just completed in the last year or two. They're really struggling to find customers. So, and I suspect that's going to hit Toronto as well. There's been a lot of construction of more office space and condo towers, of course, in major cities. And so now that we've all found out, as employers, as employees, that it is possible to work remotely, it could very well change the world. And that's going to be hard because there is a lot of debt. One of the biggest, in my book, I talk about household debt, but household debt's been growing at 5 to 10% a year for a long time in Canada, from about 2006, so 14 years. But in the last 5 years, corporate debt has been growing even faster than household debt, quite a bit faster. So, the total private sector debt is soaring in the last little while more because of corporate debt, and an awful lot of that corporate debt has gone into real estate of some sort, like there'd be shopping centers, office towers, that sort of thing. So normally that's where the biggest use of debt is, but it's also where the lenders can get the best deals in terms of the highest interest rate when they lend. Because it's riskier to lend to a property developer than it is to just a normal company. So we're going to see a big problem in the old days of these office towers having no debt on them is long gone in history. Now they're highly leveraged entities, and so if they have a vacancy rate of 10, 20, 30%, they get into trouble fairly quickly on a financial basis.
And we've seen surveys where small businesses say they're not going to be able to survive. Perhaps, a third or half of them disappear. What's that going to do to your local mall or strip mall?
Exactly. I have a couple of acquaintances that are in the property area that have a large number of tenants, residential and commercial. And as of April the 1st, now that's like 3 weeks ago. Now it seems like it's probably ancient history now, but as of April the 1st, they saw more problems with their commercial tenants than with their residential tenants. The commercial tenants are just basically phoning up and saying, I'm not paying, because they can see they're not going to have any customers, and they can't afford to pay rent if they don't have any customers. There's an awful lot of small businesses. It turns out that the rent is a really big part of their business, because they got to have a location, they got to have people coming there, and so if they can't pay the rent, it's what are you going to replace those businesses with when they shut down? Now the fast food chain stores seem to be surviving not too badly now, because they can still stay in business with different services, delivery services, and that sort of thing. But there's an awful lot of small businesses that they aren't big enough to be online, to do online sales, and if people can't come into the store, then they have no revenue. And I don't know what, I don't suppose that a lot of them will never reopen, I would think. And that, that may be that maybe they weren't doing that much business anyway, but they were paying rent to a landlord. That's the biggest thing in terms of, they may not have employed that many people, but they were paying rent.
We'll have more with Hilliard MacBeth right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking to Hilliard MacBeth. Hilliard, is there going to be a mass exodus from Alberta with the oil patch having been in trouble now for almost 5 years and no end in sight? Are people going to have to leave the province to find jobs?
So there's some of your listeners may be surprised that I'm going to take a slightly optimistic bent on this, but there is one angle to this thing that could be fairly optimistic for Alberta in the longer run. Maybe not in the next 3 months or so, but what could happen with this oil price down at $9 or $10 is some of the more expensive operations in the shale in Texas and offshore might have to shut down. So one of the things that's happened in the last 15 years, which is quite amazing really, is Alberta has been able to increase their oil exports, I don't know the exact numbers, but let's say from 2.5 million to 3.5 million barrels a day, maybe even more. Alberta is about the fourth or fifth largest, Canada, but it's mostly Alberta, in the world. After Russia, Saudi Arabia, the U.S., Iraq and Canada are roughly equal. But the big change in the world has been in the U.S. The U.S. has gone from 5 million barrels per day about 15 years ago to 13 million barrels per day. And almost all of that increase, so that's a huge, that's almost a tripling, that has come from shale oil, most of which has been from Texas, in the Permian Basin in West Texas, on the border between New Mexico and Texas. And now the thing with shale oil is it requires fracking, and fracking is expensive. So what they know how to get the oil, they know how to get it out of the ground, but these companies are constantly borrowing money to spend more money to get the money out of the ground. And very quickly after shale oil starts producing, within a year or two, it has to be stimulated again through more fracking to continue to produce oil. And so there's already been a couple of the bigger shale oil producers that have gone bankrupt just in the last month, and there'll be more that go bankrupt. So that source, that huge, call that 8 million barrels that has appeared in the system just from shale oil in the U.S., it may disappear or it may drop substantially, and that will leave opening for the Canadian exports that go to the U.S. So the Canadian exports, the oil is there. Nobody needs to frack it or do anything. The plants are built. The plants cost, if they were built a long time ago, they cost $5 billion. If they were built recently, they cost $12 billion. But the money's spent. By the way, that money will never be recovered. It's probably gone forever. It's probably not going to earn much of a return, at least on the recent ones that have been built. But that doesn't matter now. Now all that matters is, can they produce the oil and ship it to the U.S.? And the answer might be yes. If the shale oil dwindles because they can't get the money to keep developing the shale, most of the money for the Canadian oil, especially the heavy oil, the bitumen, has already been spent. And the amount of money it needs from now on is quite small. So there's a chance that we actually might continue, and when I say we, I mean Canadians, might be able to continue to provide that product to the southern part of the U.S. The refineries there can handle it better because they're set up to handle that kind of oil as well. And maybe it'll be the shale oil that takes the most of it they get on it, and maybe the Canadian producers will be able to. Now, some of the Canadian producers probably won't survive, but it might not be the debacle that some people fear. It might be the bigger debacle might be in the offshore and the shale in the U.S. And so that's not entirely optimistic, but it's slightly less pessimistic than some of the dire predictions that we've heard.
Hilliard, thank you so much for chatting with us.
Nice to talk to you again.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, macbethgroup.com. If you have any questions for Hilliard or any of our other guests, you can send them to info@howstreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.